you've been kept on your toes this year by the developments in the sector. Has the year panned out at all as you would have expected it to?
Yes, good afternoon, Stephen. It's been a tough year as expected for the banking sector, probably even tougher than most people were expecting at the beginning of the year. We've had a confluence of events, big declines in interest rates, which obviously impacts the banks heavily on the endowment effect and the interest margins that they can earn. Balance sheets effectively standing still. We've seen very little by way of asset growth, and economic activity fairly low, impacting the trading lines and the fee and commission revenue of the banks. That's really conspired to a fairly disappointing year from an earnings perspective, with the only slight bright spot being an improvement in credit quality, albeit coming through probably slower than people were initially expecting.
Well, due to all of those factors, Chris, we recently had Standard Bank going through some drastic restructuring, retrenchments at the bank. But this is going to cost it heavily this year and could push profits lower. Going into next year, though, how is Standard Bank positioned? Because it is looking at big cost savings.
Yeah, I think we should see a reasonably decent earnings recovery next year. The impact this year clearly is quite significant. They're going to take about 500 million rands worth of restructuring expenses through the P&L this year. That should allow them to benefit to the tune of up to 2 billion rands worth of cost saves next year, which positions the group reasonably well to keep the cost line relatively flat in nominal terms. But I guess what we shouldn't ignore is the fact that these cost-saving initiatives are predicated and really a response to a very depressed revenue environment. Whilst we can expect some improvement in revenues next year and obviously some operating leverage with that dropping down to the bottom line and a reasonably decent recovery in earnings, off this year's depressed base, which is likely to be below 7 Rand, even if they can produce a decent earnings performance to generate somewhere between 8.50 Rand and 9 Rands worth of earnings at 103, 104 Rand, 11.5 times forward earnings, it's still a relatively demanding multiple on which they're trading.
Chris, talk to us about FirstRand, because to me it looks like they're slightly ahead of the game at this stage, but they did seem to take their pain a little bit earlier on in the recession, particularly with the offshore trading portfolios, single stock futures and the likes. Do you think we are going to see the recovery continuing in FirstRand ahead of the others?
Yeah, I think they are going to continue to show better earnings momentum than the peers. I would expect FirstRand to deliver earnings in line with what the market is currently looking for their year end. Remember, they've got a June year end, so that'll be June 2011. Whilst the other banks, I would imagine, still stand a reasonably decent chance of disappointing expectations for the 2010 financial year. And in some cases, I still think the balance of risks to earnings for 2011 are skewed towards the downside from where consensus is currently sitting.
Some news coming out of FirstRand and its largest shareholder, that's RMBH today. FirstRand is going to be selling its stake in OUTsurance, that's a 45% stake in OUTsurance, to RMB Holdings for 3.75 billion Rand. RMBH also going through a bit of a restructuring. It's going to list its insurance interests separately. It's bringing in a new Black Empowerment shareholder. Talk to us about those changes and your feelings about those.
Yeah, it's been something that's been on the cards for quite some time. I think the most interesting element of the restructuring is the separation of the banking and the insurance entities into two separate groups, where the banking entity, post the restructuring that's being proposed, will simply be a 33.9% holding company for the newly focused FirstRand banking operations. I don't think that is the final step in the restructuring process. I have a feeling that is a stake that's being dressed up for sale. I can't imagine us having a Rand Merchant Bank holding company structure which simply holds 33.9% of the FirstRand banking group as a long-term investment on the JSE. It's only a matter of time, I would surmise, before some offshore interest wanting to acquire a credible stake in a good South African banking operation takes a look at those newly focused banking interests.
Do you think that the spotlight is now on FNB or FirstRand as opposed to Nedbank? And of course we had that disappointment a few months ago when HSBC walked away from buying a stake in Nedbank.
I think Nedbank is undoubtedly still on the block. Old Mutual have made no secret of their desire to dispose of their investment in Nedbank. It's not key to the long-term strategy of the group. I think Nedbank would be far better off with a different parent. Whether that happens in 2011, I would say the chances are still quite significant that we see Standard Chartered or a potential other acquirer coming back into the country looking to acquire a South African banking interest. The Nedbank interest is clean and simple. You get majority interest. You get majority interest from a willing seller, which means you can probably acquire it without paying too much by way of a premium. That may be attractive to a foreign acquirer. But as I say, you've also got 33.9% of First Rand Banking Group also being dressed up for sale, and were I to be an acquirer, I think that would probably give you a better leg up into the South African marketplace, albeit it doesn't give you effective control like the Nedbank stake would.
Has Nedbank been tainted by HSBC walking away in the manner that it did, with no real explanation as to why it no longer wanted to buy Nedbank?
Well, it was an unfortunate course of events. The manner in which HSBC walked away clearly led the market to suspect that they may have found something during their due diligence process that they didn't like. I would guess that that's probably not the case. I would imagine it's far more to do with the change at the helm that took place at HSBC during the course of that process, and possibly a change in strategy, choosing not to dedicate incremental amounts of capital into emerging markets at a stage where the Basel III capital requirements was still very much fluid, and the extent to which they would require additional capital in some of their jurisdictions due to their too big to fail or systemically important nature in many of those markets. It's possible that that prompted a rethink rather than any particular gremlins found during the due diligence process.
How about Investec's prospects going into 2011? This is a bank that had the most exposure to the global financial crisis, the subprime market, European debt. Many investors, though, saying Investec looking quite cheap and well positioned going into next year.
Yeah, I think Investec is looking attractively valued, whether one looks on a price earnings multiple, whether one looks on a price to book basis, possibly stripping out the asset management operations, valuing them separate, and then looking at the implied price to book multiple on the balance of the business. The balance sheet's in pretty good shape, probably too much liquidity on the balance sheet at the moment, insufficient lending taking place. Capital levels look reasonably robust regardless of whatever the regulatory outcome turns out to be. I think once we've got increased regulatory clarity, Investec is quite well positioned. Clearly the extent of the rebound remains uncertain, and I think it's a little bit early to start calling the extent of the rebound. We saw in the wake of the 2002 local Tier 2 banking crisis, we saw a very strong earnings recovery from Investec subsequent to that. I have a feeling the earnings recovery might be slightly more muted than that, but once the global economy returns to the front foot, even if that turns out to be on a relatively muted basis, I think Investec is well positioned.
Chris, so just in closing, after what looks like a bit of a false start in 2010, everything looking a little bit better for the banking sector in 2011?
Yeah, I think a lot of the negatives that impacted the sector during 2010 will be mitigated during 2011. I have a feeling margins will remain under pressure as interest rates either remain flat or possibly even fall further into next year. So we're going to have a continued negative endowment effect, but the impact of that will be significantly less than it was in 2010. I would expect some degree of balance sheet recovery and asset growth, albeit relatively muted compared to historic cycles, given the current level in indebtedness in the domestic market. And one should see some tentative increase in activity levels. So the environment will be better, credit quality should continue to improve, but I would caution against getting overexcited in terms of the earnings recovery one's expecting in 2011.